Members of Congress know and use these secrets. In this episode, I'm going to address what are the secrets to a tax-free retirement. Get ready. I've been empowering people to learn these secrets for more than 4.5 decades. So my name's Doug Andrew, and I've been helping people optimize their financial assets and minimizing taxes for more than 4.5 decades. I'm a pretty old geezer. I'm 69 as of the recording of this episode. But during all of my career, I've helped people accumulate their money tax-free and then be able to access their money tax-free. And at the end of the day, when they finally pass away, they leave behind a huge nest egg, totally income tax-free, to their spouse, their heirs, their church, a charity, whoever they want. And it's using a vehicle, which I call the laser fund, which actually helps them to diversify and create the foundation for a tax-free retirement, or to use those funds for all kinds of other goals. But do you know, in one form or another of printed material or audio or video education, I have sent out over $1 million episodes, books, articles about the secrets of a tax-free retirement. Do you know, for over a decade, I sent out thousands of these big envelopes to people who requested them. I'm going to show you how you can learn this without necessarily having to read this particular ebook. This was a 38-page book that I sent out to people, and a lot of times they wanted to have a hard copy because most of the people who were interested, they were like 55 to 75 years old, and they liked to read something they could hold in their hand, and they didn't want to read one of my full 300-page books. And so they would order this, but I also included inside of this envelope the audio version also. So let me just share with you in this episode what I talk about in this 38 pages, Secrets to a Tax-Free Retirement. It says, protect yourself from the dangers of increasing taxes, market volatility, by using my favorite vehicle, an MFTA, that stands for Max Funded Tax Advantaged IUL, Indexed Universal Life Insurance Contract, where I have earned average returns between 7 to 10%, but many years we've had clients earn 25%, 30%, and even 61.33% this very year that I'm recording this episode in 2021. So get ready, put on your seatbelt. I'm going to share with you a few glimpses of the secrets to a tax-free retirement, and then stay with me to the end. I will gift you a copy of my most recent 300-page best-selling book, The Laser Fund, shown here on the screen, which is actually 2 books in one. This side is 200 pages with charts and graphs and explanations. This side, when you flip it over, has about 62 actual client stories of how the Laser Fund is the dream solution for all kinds of financial goals. Now, what I always share in my various publications and my educational videos is that Americans do not have to put their money at risk, be subject to market losses in order to try to get ahead in the long run. You can participate when the markets go up, but not lose when the markets go down, using one of my favorite strategies called indexing. And that's why I love to put money into an indexed universal life insurance contract so that I can accumulate my money tax-free and access my money tax-free. It knocks the socks off of a Roth, and be able to be immune from taxes, inflation, and market volatility. Let me show you the secrets to a tax-free retirement based on the actual Internal Revenue Code. You ready? In the Internal Revenue Code since 1986, tax reform. Who was president of the United States in 1986? Ronald Reagan. It was his second term. And so he passed what is called the 1986 Tax Reform Act. Ever since then, Americans only pay income tax on 3 types of income: earned, passive portfolio income, earned income, salaries, wages; passive income, that's like rental income or lease income; Portfolio income would be interest or dividends. Those are the only three types of income Americans pay income tax on the front page of your 1040 tax return. My favorite vehicle, which I call the laser fund. Laser is an acronym that stands for liquid assets, safely earning returns, is not deemed to earn passive or portfolio income. $1 million nest egg can generate $80,000, $90,000, $100,000 a year of tax-free income, and people say, why is it tax-free? Well, it's a sacred tax-free cash cow in the Internal Revenue Code for over 107 years because it takes pressure off of the government to use tax dollars to take care of people who didn't save and on and on and on, or if they die prematurely. But if I simply cut to the chase, because the laser fund generates cash flow or income that is not fall under one of those three umbrellas, there is nowhere on a tax return to put it. It's not a secret. The IRS knows if you have one and the $1 million nest egg is generating $100,000 a year of income, they know it's tax-free. They don't even need to audit you because it's been sheltered for over a century. It's not one of those three types of income, okay? So let me explain why and how. In the Internal Revenue Code, for over a century, Section 72E allows you to accumulate your money tax-free inside of a max-funded insurance contract. What's that? That's basically a life insurance contract where you're doing the opposite. Instead of trying to get a bunch of death benefit for the least premium, you're doing the opposite. You're trying to get away with the least amount of insurance the IRS will let you get away with and put in the most money, the most premium the IRS allows as fast as they allow, because you're going to use it for living benefits, not just the death benefit. 72E says that I can accumulate my money inside of there tax-free. 7702 says you can access the money for living benefits tax-free. So that if you're in your 30s, 40s, 50s, it doesn't matter. Whenever you want to access money, you can access your money, including the gain, if you do it the smart way, without paying tax. This is far better than a Roth, by the way, and you can learn with other videos on this very channel why. By the way, if this is already intriguing you, I would recommend you subscribe to this three-dimensional wealth YouTube channel. It's free. Click the little bell so you'll be notified every time I post a new in-depth answer to a financial question. I do it almost on a daily basis. But stay with me to the end because I want to gift you a copy of my most recent best-selling book called The Laser Fund. And this will blow you away with opportunities you never knew existed before. It will teach you about this. But 7702 allows me to access my money tax-free. Section 101A of the Internal Revenue Code allows that any money that I have in my account, in my insurance contract when I die, now blossoms, increases in value and transfers tax-free. If I died right now at age 69, every million would blossom to about $2.5 million and transfer tax-free to my wife, my kids, my grandkids. There's not a Roth around that'll do that, see? And so these are like a sacred tax-free cash cow sections of the Internal Revenue Code. Now, TEFRA, DEFRA, and TAMRA are actually tax citations. You'll learn in the book that this is the Tax Equity Fiscal Responsibility Act of 1982, and this is the Deficit Reduction Act of 1984. It basically says, you know what? If you want to use one of these insurance contracts for living benefits, it shows you how you can squeeze down the death benefit as tight as possible based upon your age and gender, so it doesn't matter if you're a 22-year-old athletic marathon running female, or if you're a 60-year-old, or if you are a 79-year-old and you've had an adult onset diabetes, a prostate cancer episode, and 3 blocked arteries cleaned up with angioplasty. I have a friend of our family who had that. We all can have one of these, and we can be earning 11% and netting 10% because the cost of the insurance that the IRS says has to be there in order for it to be tax-free is the same for the 20-year-old as the 60-year-old as the 79-year-old, because the amount of insurance required goes down as you get older. This is incredible. You wouldn't believe how many financial advisors and even insurance agents don't understand what I just said. That's TEFRA and DEFRA. It gives parity. TAMRA, the Technical and Miscellaneous Revenue Act of 1988, says you have to fund it over at least 4 years and 1 day on the average. Okay, if you're over age 50, you can do it faster than that if you're under age 50, in order to have it be tax-free when you access the money. You have to jump through certain hoops. So I've compared this oftentimes to like a bucket. These talk about how you can have the insurance qualify for tax-free accumulation, access, and transferability. Tamra basically says if you want to have tax-free income forever after, you want to be grandfathered to have that, your account is like a bucket. You design it to accommodate the amount of money you want to put in there, whether it's $20,000 a year, $100,000 a year, $1 million a year. See, this is not like an IRA or 401k. You get to determine the amount of money you want to be grandfathered to put in there. You don't have to put in that much. You can make up or catch up for the years you don't put in the maximum amount. But the fastest you can put it in, based upon Tamra, is 20% a year. So let's say I want to be grandfathered to put in a grand total of $500,000. I could put in up to $100,000 a year. $100,000 the first day of the first year, $100,000 the first day of the second year, and then the third year and the fourth year, and finally in the fifth year, which is actually 4 years and 1 day later, I have my $500,000 in there, and this thing can double to $1 million. $1 million doubles to $2 million. $2 million doubles to $4 million. $4 million doubles to $8 million. Yeah, we've had many clients who have experienced that exact scenario. And now, whatever you end up with when you retire, $8 million, we have a client with $8 million bucks. It's generating $600,000 to $800,000 a year of tax-free income forever because they complied with TEFRA, DIFRA, and TAMRA. That's the power behind this. So let's go through how it eliminates the dangers that I referenced earlier. So why is the Laser Fund one of my favorite financial vehicles? Because I have found that most retirees outlive their money based upon 3 big dangers, and the Laser Fund eliminates these dangers. It makes yourself immune from them. Here we go. The biggest danger is taxes. Taxes are not going down. Taxes, most people believe, are going to be higher in the future. The Laser Fund's tax-free. Inflation. I can link my returns to the things that inflate. If inflation goes to 10%, I've usually earned 15 or more. If it goes to 15, I earn 20. If it goes to 20, I earn 25. You can learn how to outpace inflation by watching episodes on this very channel. Just search inflation, okay? And also, I eliminate the danger of market volatility because I can make money when the market goes up and not lose one dime due to market volatility when the market goes down using a strategy called indexing. So the greatest opportunities that you'll read about in the book I'm going to gift you is to convert to tax-free vehicles using the Laser Fund, link your returns to the things that inflate, so inflation helps you instead of hinders you, and use indexing so that when the market goes up, you get to benefit. When the market goes down, you don't lose. Sound too good to be true? No. We have thousands of people that have been utilizing this very strategy. Why do I like the Laser Fund? Because it passes the liquidity test. I can access my money when I need it. Anytime. I don't have to wait till I'm after age 59 and a half. I can put in whatever amount and I have access to it. Liquidity, I have safety, not only of the institution, but safety of principal. Any year I make money, that becomes newly protected principal. I lock in the gain I make and I reset. In 2017, we had a lot of clients that locked in gains of 16%, 25%. On $1 million, they made $250,000. The next year, if the market would have crashed, they still would have had $1,250,000 at the end of that year. They may not have made anything if the next year crashed, but they didn't lose. And so that's called safety of principal. And then predictable rates of return that historically have beaten inflation. Here's how you can claim your free copy of the Laser Fund book. Simply go to laserfund.com, L-A-S-E-R fund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. I'll fire out a hard copy of this 300-page book to you. There's also options there if you like to listen and learn or watch and learn. And also we have educational webinars. Again, I implore you to subscribe to this channel and click the bell to be notified every time I post an in-depth answer to a financial question. But this book is actually 2 books in one. As shown here, the right-hand side, the white here, It is about 200 pages, 14 chapters with all the charts and graphs and explanations. But if you're more of a right brain learner, you learn by stories and examples. You read the orange covered side by flipping it over. This is 100 pages, 12 chapters with 62 actual client stories. So claim your free copy now, and here is to your brighter future.